capital flows, you can broadly divide capital flows into two parts, equity and fixed income or debt, right? Equity capital flows are usually very sensitive to the growth prospects of a country, right? Whether a country is doing well economically, there is a lot of growth, so outsiders would want to invest, create capacity, invest capital into this country, and that sort of determines your equity flows. Fixed income flows or debt capital flows are largely driven by relative difference of exchange of interest rates, as well as the credit rating or the credit standing of the country in which the flows are coming in, right? Now, the interest rate differential between India and the next major economy or the largest economy, which is the US, has actually been narrowing over the last, I would say, three odd years. Which basically has meant is that most of the capital flows that have come into the country over the last 2 to 3 years are equity flows. They are not debt flows. In fact, there has been a very, very limited amount of fixed income flows that we have seen, particularly in the last 2 to 3 years, as this interest rate differential has kind of narrowed.
So, Neeraj, two questions from here. First is, there seems to be a linkage between interest rates, inflation and foreign exchange. So, if you can just explain what that is.
Yeah, so I think generally in an economy, the interest rates are a function of the inflation in the economy, right? And I'm again give you an example of recent past. In US, for example, the inflation was very close to zero, less than 2%, but fairly close to zero for a fairly long period of time. Therefore, interest rates in US were also very close to zero for almost like a decade and a half now, since the global financial crisis. India, on the other hand, has had an average inflation rate of about 4 to 5% and actually even higher maybe sometimes.
Correct.
And that is why our interest rates are more close to 6 to 7% as compared to US, where the interest rates were close to zero. As the inflation goes up, there is a need to compensate the savers more for deferring their consumption, which is that deferment of consumption requires compensation, and that compensation is what the interest rate is.
So, just to kind of simplify this further, as a consumer, I have a choice of spending today versus saving it and spending it a year down the line. If the inflation is high and the interest rate is not high enough, then I know that a year down the line, I'll be able to get lesser value for my 100 rupees versus today. So, I'll spend it today, and hence the interest rate has to be higher to incentivize me to save it.
Yep. So, if I want you to defer your consumption from today to a year down the line, I have to pay you adequate compensation for you to defer it. Otherwise, there is no incentive for you to defer it, right? Yep. And the deferment of consumption is nothing but the interest rates, right? Yep. So, this is called a Fisher equation in some senses. Yep. So, as the inflation goes up, the need to compensate more increases, and that is what the interest rates are, and hence interest rates are required to be increased, right? Foreign exchange, if you think about this in today's context, is it's money, it's currency, right? So, therefore, there has to be an element of interest rates into it, right? Interest rate differential between the two countries is nothing but relative differential of deferment of consumption, right? And hence it is also linked to the
Forex,
the inflation differential, right?
So, if I were to again kind of to put it in my words, in the economy, to incentivize me, somebody had to pay me higher interest rate. Now, if I think of myself as a global citizen and I have two quote unquote real interest rates, which means interest rate minus inflation is the real interest rate, right, in some ways. Now, if the US real interest rate is 0 and the Indian interest rate is 2%, then I will put all my money into Indian interest rates, provided the Forex is flat, which means for there not to be any arbitrage opportunity, the rupee has to depreciate by 2%.
That's right.
And hence the differential in real interest rates is a predictor of future depreciation of the...
Well, I would not use the word predictor of,
right.
But in a very mathematical sense, the forward value of rupee or the future value of rupee and the future value, or rather the future value of rupee in terms of dollars should be equal to the interest rate differential
Differential
between the two countries, right? Otherwise, there is what is called an arbitrage situation,
Right.
and you have people coming in and arbitraging between the two countries,
Right.
two currencies, right? So this is what we call as a no arbitrage interest rate differential equation,
Right.
right? In reality, life is a little bit more complex than this. The markets are not perfect, and hence you have situations at times when the
Of course.
forward pricing of a currency is different from the interest rate differential, right?
Right.
But to come back to your original question, yes, inflation, interest rate, and foreign exchange values are all linked to each other.
Right.
Foreign exchange values in the forwards are determined by the interest rate differential.
Right.
Interest rates themselves are a function of inflation in an economy, and hence by corollary the foreign exchange values are also a function of the inflation in an economy.
Right.